Assalamu alaikum, greetings to you all. Sorry about the slight delay in starting the webinar. We had a few technical issues. Um, just before I introduce the speakers, a couple of technical points that I need your input on. So it makes it a smooth webinar. In terms of the slides, they will be in Arabic, as compared to the one we had in Q1 where we had English language slides. Within the Zoom interface, there's a button for interpretation. If you select that, the Arabic option, what's going to happen is there'll be live translation as we go along. We'll cycle through the Arabic language slides. You can listen to the presentation in real time in Arabic. If you're an English speaker, there's an English speaking option, and you can select that, and that should also give you access to the same material, but in English. So that's for housekeeping. In terms of the panelists for today, they need no introduction, but I'll give it a shot anyways. We're joined by two members of the IVSC Standards Boards, Alexander Aronson, who you have had on previous webinars, is a fellow of the Royal Institution of Chartered Surveyors with a long and wide-ranging experience encompassing residential asset management, commercial property, rating, and international valuations and investments. Alex is the IVSC, or International Valuation Standards Council, Director of Technical Standards, and he works with the IVSC Standards Review Board and the Tangible Assets Boards on drafting international valuation standards, perspective papers to inform the profession on topical issues, presentations, training, and articles. In addition, Alex has a leading role in various international standards coalitions and setting committees. He's the Executive Secretary of the International Property Measurement Standards Coalition, the International Ethical Standards Coalition, and the International Land Measurement Standards. Prior to joining the IVSC, Alex was with the RICS, that's the Royal Institution of Chartered Surveyors. He was the Director of Technical Standards, and he was also the Executive Secretary of the International Fire Safety Standards Coalition. He's a member of the International Construction Measurement Standards Coalition as well. Hank, who sits on the Business Valuation Board of the International Valuation Standards Council, is the Managing Director of QVO Values in the Netherlands, an independent valuation consultancy for quality valuation opinions. Hank has been involved in valuation engagements covering a wide variety of industries, including technology, information, communication, and entertainment. Prior to setting up his own practice, QBO, Hank was a managing director at Duff & Phelps, now known as Kroll. And prior to that, Hank was a managing director at Standard & Poor's Corporate Valuation Consulting. He was also an assistant professor of corporate finance at Tilburg University in the Netherlands, and a visiting professor to the J.L. Kellogg Graduate School of Management at Northwestern University. Hank received his MBA in Operations Research and Econometrics and his PhD in Corporate Finance from Tilburg University in the Netherlands. And Hank has also authored several publications and articles showing some subject matter expertise. My name is Paco. I consult on valuation matters for Takeen. And prior to that, I was with Duff & Phelps, now known as Kroll, the valuation practice. I was a director in the real estate advisory group and also in the tangible assets practice, which included process plants and equipment and machinery and equipment generally. I sit on the tangible assets board of the IVSC, and I'm also on the RICS, Royal Institution of Chartered Surveyors' Global Valuation Professional Group panel. At this juncture, I'll hand over to Alex to start the presentation.
Thank you. Salam alaikum and greetings to you all. Thank you all for joining this presentation on the latest edition of the International Valuation Standards. Next slide, please. First of all, I'd like to give you a little bit of an overview of the International Valuation Standards Council. So The IVSC was established in 1981 with a mission to build trust in valuation. And we do this by two ways. One, establishing globally consistent, high quality international valuation standards across all asset classes. And that's what we're really here to talk about. And also to encourage quality valuation professionalism globally. IVSC is a global organization with partners including other standard setters, regulators, valuation professional organizations, valuation service providers, and the end users of valuation information. In October 2022, IVSC and IOSCO, who are the global regulators, executed a statement of cooperation whereby both organizations endeavor to enhance their collaboration with the aim of identifying approaches to promote high quality valuation practices. We entered into a similar statement of cooperation with WIPO, the World Intellectual Property Organization, in 2023. And our standards are principle based and they're applicable for all valuations of any asset or liability. Next slide, please. So first of all, IVSC was published on the 31st of January 2024. The effective date is the 31st of January 2025, though early adoption is encouraged. You'll notice that in addition to the publication of the standards, we also have a red line version of the standards, which allows you to see the changes since IBS 2022. We've also published a basis of conclusion. And the standards are very much interactive. So if you hover over a definition in italics, it will show you the definitions, and you can easily move between chapters by clicking on the chevrons, and you can also click on the references to go to the relevant section. And you can see on this slide a PR code, which will allow you to have access not only to a copy of this presentation, but it would allow you to buy a hard copy of the standards. Next slide, please. So looking at the structure of the international valuation standards, you can see the top line deals with the general standards, which is everything from your initial instruction all the way to your documentation and reporting. And the general standards relate to all asset classes and asset standards, and they provide additional requirements for valuation. We also have underneath this asset standards, which give you further details in relation to particular asset classes. And the revised compliance section within IVS 100 framework clarifies the necessity of adhering to the general standards and asset standards, but also to prioritize legal and regulatory requirements where conflicts arise to maintain IVS compliance. Next slide, please. So when we began this process, and it is quite a long process, as you'll see from the next slide after this, we had a number of goals. One was to address changes in global markets and global valuation, including the increased use of technology and the abundance of available data sources, to describe the roles and responsibilities of specialists and service providers increasingly used by valuers in the performance of valuations. And I'll pause there for a minute. Remember, it's international valuation standards, not international valuer standards. So there are a lot of people involved in this process in addition to the valuer. We also wanted to align the international valuation standards with the valuation processes that valuers perform to provide clarity, understandability, and relevance to stakeholders, including financial institutions, investors, and regulators. And we wanted to create standards which allow for new types of assets or liabilities and expand the application of their valuations into areas such as environmental, social, and governance. And we wanted to ensure that we provided consistent requirements across all assets and liabilities. Next slide, please. Now you can see on this slide that actually standard setting takes some time. We developed draft standards based upon feedback from our agenda consultation that was initially issued in 2020 and our IVS 2021 technical revisions. We issued the IVS exposure draft on the 28th of April 2023, and this was subject to a 90-day consultation period, which closed on the 28th of July 2023. The IVS Standards Review Board and all the individual asset boards then assessed the responses and updated the standards accordingly. And on the 29th of November 2023, the Standards Review Board voted to accept the updates proposed based upon the consultation. And the standards were published, as mentioned, on the 31st of January 2024, with mandatory adoption on the 31st of January 2025. Next slide, please. So during the course of this presentation, we're going to talk you through some of the key changes in relation to the general standards. So we have a structured valuation framework, clarification of key terms, new chapter on data and inputs, IVS 105, a new IVS 104, a new chapter on valuation models, IVS 105, section on valuation process quality controls contained with IVS 100 framework, new requirements in relation to documentation contained within IVS 106, documentation and reporting, standards in relation to ESG and sustainability. In some markets, these terms are used interchangeably. Valuation review and revisions to compliance. Next section, please. So I'd like to talk first of all about the valuation framework. And you can see here from the chevrons, as you move from right to left, the actual framework of the standards and how you end up with an IVS compliant valuation. And we developed a framework that can be universally applied across all classes of assets and liabilities to ensure a systematic approach to enhance rigor and control in valuation processes and to mitigate valuation risks. The asset standards provide additional requirements to the general standards for specific assets and liabilities, and the appendices provide additional information and requirements for certain concepts articulated in various chapters. Next slide, please. So one of the things we really wanted to do was clarify key concepts. So these include requirements that must be followed in all circumstances and those that should be followed. So we have a two-tiered hierarchy. Must is mandatory, should is presumptively mandatory. So if you're not following the requirements, you should note in your documentation the professional judgments that you've made that mean that you don't have to follow those requirements. We also wanted to distinguish between valuation and valuation review. So a valuation review, we have two types of valuation review. We have a valuation process review, which is where you're reviewing the valuation to see if it's compliant with the IVS standards. And we have a value review where you would be reviewing one or more of the components of the valuation, such as the comparables of the yields, to see if your opinion, it is in a sort of reasonable range. But I can't state clearly enough that a valuation review is not a valuation. If you are asked to provide an opinion of value, that is a valuation, and you would need to follow all the requirements of IVS and within the Taqeem manuals. We've also tried to give additional clarification on compliance with IVS and other legal, regulatory and reporting standards. Next slide, please. So on this slide, we're looking at compliance, and the revised compliance section in IVS 100 clarifies the necessity of adhering to general standards and asset standards and prioritizing legal and regulatory requirements where conflicts arise to maintain compliance with IVS. And it states there, in order to be IVS compliant, the valuation must meet the requirements of the general standards, the appendices, as well as the asset standards, if applicable. We also state that in certain instances, a valuer may be asked to conduct a valuation review for compliance with IVS. In such instances, the valuer should comply with the IVS and the applicable review frameworks as defined in the scope of work. Next slide, please. So IVS 104 is a new chapter within IVS, and it deals with data and inputs, and it addresses the importance of data quality and valuations, and it requires valuers to assess and select data and inputs using professional judgment. And data is the macro. It's all that qualitative and qualitative information available to the valuer that should be contained in your file. So it's the pool of the information that you considered, whereas the input is the data assumptions and adjustments determined to be relevant and assessed or selected by the valuer to be used in the valuation. And this is based on their professional judgment. And we have characteristics of data, and you'll notice that the characteristics of data and valuation models interconnect, because in some instances, you'll look at your data first, you'll go to a model, you'll input it in your model, and you'll find that the model's not working correctly. So you would either review your data or you would review the model that you're using. But the most overarching characteristic for data is that it should be relevant and observable. And underneath that, we have a number of characteristics. Accuracy: the data is free from error and bias and reflects the characteristics that they're designed to measure. Completeness: the set of data is sufficient to address attributes of the assets and liabilities. Timeliness: the data reflects the market conditions as of the valuation date. And transparency: the source of the data can be traced from their origin. And when looking at these characteristics, the valuer needs to maximize as many as possible. There's no such thing as perfect data. Some data is better than none. And at the end of the day, you can only use the data that is available to you. Next slide, please. I hope that's the right side, because my Arabic is not great, but the next slide should be dealing with valuation models.
Yeah, it's a previous slide. Alex, I think it's a previous slide.
I think it's the previous one as well.
Yes, this one, yes.
This one.
Yeah, correct.
So valuation models was previously contained within valuation approaches and methods. And we agreed that we needed, it's so important, we needed an actual standard on it, which is IVS 105, and it addresses the selection and use and stipulates that models must be supplemented by professional judgment to achieve IVS compliance. In fact, we've gone a bit further than this. We say IVS 105 addresses the selection and use of models to be used in the valuation process, but no model without a valuer applying professional judgment, for example, an automated valuation model, can produce an IVS compliant valuation. But I'll just pause here and just give a little bit more detail. We're not saying you can't use an AVM as a tool within your valuation, but an AVM on its own won't produce an IVS compliant valuation. And we're happy to answer questions on that later as well. But this chapter deals with the characteristics of appropriate valuation models, and the overarching characteristic is actually the model must be appropriate. It must be fit for the purpose. And we have 4 other characteristics which interconnect with the characteristics of data. So accuracy, the valuation model is free from error and functions in a manner consistent with the objectives of the valuation. Completeness, the valuation model addresses all the features of the asset and or liability to determine value. Timeliness, the valuation model reflects the market conditions as of the valuation date. And transparency, all persons preparing and relying on the valuation model must understand how the valuation model works and its inherent limitations. And this is one of the reasons why an AVM can't produce an IVS compliant valuation, because the valuer needs to understand how the model works and any limitations within that model. Now, we're not saying that you need to be a computer programmer. We're not saying you need to program the model. What we're saying is the valuer needs to understand the basic workings of that model and any limitations within that model in order to provide a valuation. Next slide, please. So this one deals with valuation process quality controls, and it was the view of the boards that quality control is an extremely important part of valuation. It's a core component because it ensures objective, transparent valuations, adhering to IVS and mitigating valuation risk. And there must be valuation process quality controls around the valuation process. And a valuer should conclude that the level of valuation risk is appropriate given the intended use, which is a definition within the IVS glossary, intended user, which is also a definition within the IVS glossary, characteristics of the asset or liability being valued, and the complexity of the valuation. And within this section, we also state that valuers may perform monitoring procedures with respect to their own compliance and their control policies and procedures if valuers are able to address valuation risk. So a sole practitioner can quality control their own work, providing that they can show that they've reviewed the valuation risk in their procedures and in their valuation. And a valuer should conclude that the level of valuation risk subject to the controls in place is appropriate given the intended use, intended user characteristics of the asset or liability being valued and the complexity of the valuation. Next slide, please. Documentation. Now, IVS 106 now includes documentation requirements to maintain sufficient records of the valuation process and conclusions to help ensure consistency, professionalism, transparency, comparability, and trust in valuation. And that documentation should also describe the professional judgments made during the valuation to assess and manage valuation risk. And it's stated in the standard that documentation is the written record of the valuation or valuation review. I know there is a separate manual on valuation reviews and may include communications with the client, working papers, or both used to support the conclusions reached in compliance with IVS. And I'll just pause here for a second because I'd like to elaborate a point on this slide that unfortunately, we often live in litigious times. And when valuations go to litigation, it's not at the time that you do your valuation, it's several years later. So remember, that documentation that you have on file is your protection. It's your support of your valuation. So that documentation should be as complete as possible. It should record the data that you reviewed before deciding your inputs, and also the judgments you made in terms of choosing those inputs, the valuation approaches, and the valuation methods. Next slide, please.
Alex, thank you. This is for the audience. Before we move on to the next slide, a bit different from the last session we had where the questions and answers were interspersed with the presentation. The format this time around is slightly different. We're going to go through all the slides because we're pressed for time. Once that's done, I will address the rest of the questions. So I'm going to stop answering questions now, and we'll address them live once the presentation is done. Yeah, thank you.
And just adding to Paco's comment, not only will we try and endeavour to answer any of your questions, but if for any reason we don't have time for your questions, Paco will send them on and we will try and give you a written response to your questions as well. So hopefully if we move to the next slide, please. Environmental, social and governance considerations. So to reflect the growing global focus, IVS expands ESG considerations and valuations across all specialisms. And we've included an appendix on ESG within IVS 104, data and inputs, which requires the valuer to consider the impact of significant environmental, social and governance factors to the extent that they are measurable and would be considered reasonable by a valuer applying professional judgment. But we've noted that ESG is still in developmental stage. We're continuing to work on this. We will be producing a perspective paper later this year on ESG and plant equipment and infrastructure. We also currently have a survey on ESG out, and I do ask you, because the survey closes in 9 days on the 31st of May, please participate in the survey. It should only take 5 to 10 minutes, and we will issue a report to show you where values are. And that's partly because our job as standard setters is not to lead the market, but to understand market needs. So within this section on ESG, we state that the valuer should be aware of relevant legislation and frameworks in relation to ESG factors impacting evaluation. And the reason we say that is this is a fast-moving arena. You have the International Sustainability Standards Board who have issued standards. You have the EU taxonomy. You have particular standards within your market as well. And we state that the impact of significant ESG factors should be considered in determining the value of a company, an asset or liability. So remember, it doesn't just relate to businesses, it can also relate to assets. And ESG and the regulatory environment should be considered in valuations to the extent that they are measurable. Not everything is measurable and would be considered reasonable by a valuer applying professional judgment. Now, that doesn't mean that you shouldn't necessarily have some qualitative statements within your valuation report, making people aware of risks, but not everything can be done quantitatively in relation to ESG at the moment. So the next slide, please. And I believe we should be now moving to my colleague Henk Oosterhout, who will be talking you through the business valuation standards. So over to you, Henk.
Thanks, Alex. And I think the environmental, social and governance slide is a good bridge into the valuation standards in the category of the 200s. In the 200s, we go about the concepts of business valuation and intangible asset valuation. So I will go with you through both of them. But before doing so, let's move to the next slide and see how the business valuation standards chapter, so to say, the 200 is organized. As you can see on this slide, the international valuation standards are categorized in 4 buckets, right? The numbers 200, they deal about the valuation of businesses and or business interests. I'll come back to that in a second. Then the international valuation standards number 210 and onwards, they are about the intangible assets. So any long-lived assets, you know, that are intangible in form, stuff like technology, brand names, but also customer relationships. I'll also come back to that one. The number 220 and up, that's the non-financial liabilities. I will also give a few examples there where probably the most important one is a deferred income one. And then the 230s, which deal with inventory, clearly a tangible short-term asset version, but also a relevant one when it comes to the business valuation standards. In the exposure draft for that led to the updated valuation standards, it's fair to say that there were not that many changes into this chapter of the 200s for the business and intangible asset standards, but let me walk you through them. In doing so, can we go to the next slide, please? So the next slide, you see, the business valuation standards from the 200s. What are the key revisions that were being performed in the latest update of the standards? They mostly deal with aligning the business standards with the general standards, right? Alex already took us through the general standards, in the 100 section, and there we managed to link the 200 section a bit stronger where need be with the general standards in the 100 standards. Furthermore, we changed some elements when it comes to the clarification of the parameter and scope of valuation. What is leading there? Are we talking about a beneficial owner? Are we talking about a controlling or a non-controlling interest, so to say? We also did some adjustments, in the income approach for the business valuation, minor ones, but key ones. And we talked a bit more about the lifing of the intangible assets. So not only talking about the valuation of several intangible assets, but also about the lifing of it. And we did some other edits. So all in all, you can say that in the business valuation standard, so in the numbers 200, we mainly deal with the three key valuation approaches. The leading one, of course, being the income approach, with a very specific attention to the discounted cash flow approach. But also we spend their time on dealing with the market approach, both the market approach when it comes to comparable companies, but it could also take the form of comparable transactions. And the third approach next to income and market is the cost approach here. Let's then move to the next slide and go to the intangible assets, right? No. First of all, I would like to say something more about expected changes. So we have now the standards ready for 2025. We are, of course, as board members, always key to know what are going to be the next changes, right? So what do we see as developments on markets and how to interpret them and how they may lead to changes in standards. What we do see going forward is two main things coming to us. One is we see that ESG, environmental, social governance, or, in one word, sustainability aspects will lead to impact on valuation. On that one, our current vision is that it could be a very complex topic. On the other hand, the implications of it for example, an income approach, they're relatively straightforward, right? I mean, if you look at ESG factors, and ultimately you have to determine what their impact is on very simple, the cash in or outflow. I mean, an income approach, it basically consists of an amount of expected net cash flows, and for a certain number of years going forward. So the ESG factors should also be incorporated in that framework, and you should try to quantify what the impact is on those net cash flows going forward. Another aspect, of course, where ESG may have an impact is that ESG could affect the discount rate. If ESG is allowing you to lower your risk profile, it may have an impact on the discount rate, leading to a lower discount rate. And ESG could, of course, also impact your long-term growth rate, right? I mean, if you happen to make your business model more sustainable, an impact could be that your long-term growth rate will slightly move upwards and therefore maybe positively impact the valuation. Next to ESG, we clearly see a stronger relevance of what we call the internally generated intangible assets. What you do see is that more and more companies these days, and particularly the larger or largest listed companies, the likes of Apple, Amazon, Nvidia, Microsoft, right? I mean, these companies, they clearly benefit, very strongly from so-called internally generated intangibles. So considering the relevance of them, you are confronted with, observations that the market to book multiple of these companies can be extremely large. And it could be like 20 or more, right? Which basically tells you that the market value of a company like Apple way outweighs the equity value of Apple in the books so the Apple equity value is in the books on the balance sheet of Apple. And therefore, we would like to explain, or better be able to explain, the delta, the large delta between this market and book value. If we would like to do so if we would like to get a better grip on internally generated intangibles, we are a strong proponent of giving more disclosure on the expenses made by these companies on these intangibles. For example, when you talk about Apple, we would like to see more disclosure of their marketing expenses. How much do they spend on marketing? Why do they spend so much? So we foresee for the upcoming updates of the international valuation standards, right, which are there to be used from 28 onwards, because we have a 3-year program, as Alex already indicated. We foresee that there is a larger demand, a larger requirement for more disclosure on expenses being done by intangible-rich companies. And then these expenses you can think of are next to marketing expenses, as I already mentioned, for brand names. They can also link to R&D expenses when it comes to technology. So we'd like to know a bit more about the how and why of R&D expenses. But they could also be much more detailed on sales expenses when you talk about how you're dealing with your customer relationships, right? So we are looking there for more disclosures. And as you can see from the website of the IVSC, we have also written already several perspective papers on this topic, right? So in order to take our community of members and other interested people, to take them through our ideas about, what's going to happen here and why, we write so-called perspective papers. And we are about to finalize, I think, Alex, a 6-paper series on internally generated intangibles. And I can recommend you all to take a closer look at these perspective papers just to see what's happening there and how that can be of relevance to your evaluations. Let's go to the next slide, please. Then on the next slide, you see a bit more what, we think are further demands from the valuation community to put on our agenda for upcoming analysis of these questions and their impact potentially on the standards, right? And here you see 10 of them being mentioned, right? Where we think that these elements can have an impact also on the standards for business valuation and intangible assets, right? We expect that there will be more attention for technology evaluation. So in particular, the use of artificial intelligence and how that may impact valuations. We foresee some more discussion on basis of value. That could be, for example, a discussion about the concept of prudential value as being often used by the financial regulators. We could talk a bit more about, cryptocurrencies. How are we going to value these assets? How and why? What type of assets are they? We already mentioned ESG and the impact on the standards. There could be some discussion on valuation risk. And then one of the elements of valuation risk is also reflected in what are so-called reasonable valuation ranges. So as you know, quite some valuations end up not only with a point estimate of value, but also on a reasonable range. What can be said on, the size of a range, or what should a range reflect, those type of items. We'll talk more about the valuation of startups or early stage businesses. We see more and more, let's say, outsourcing of R&D activities from the larger, tech companies to smaller companies, how to deal with them. And, linked to the reasonable range thing is also how to weight certain findings, right? When you talk about scenarios or different observations. Let's go to the next slide, please. Then, a couple of other elements worthwhile mentioning when we talk business valuation and intangibles are next to ESG is the link between ESG and the valuation standards that we have issued together with the new standards, upcoming standards of the ISSB, the International Sustainability Standards Board, right? They issued S1 and S2, where they talk a lot about, disclosures on sustainability matters. And, as can be clearly noticed from S1 in particular, the ISSB would like to come up with much more valuation disclosure on all types of assets that link with sustainability. And that can lead to clear impacts on our valuation standards here. Another important topic is, what is going to happen with standards or valuation between publicly owned or listed versus privately owned assets. There is definitely a trend for companies to also go private, right? There's loads of private money available, taking publicly listed assets and firms away into the private zone. And then the question is, does it have any impact on valuations? We already talked about the intangible assets, particularly the internally generated one, and their improved or enhanced need for more disclosure. There's worthwhile mentioning here a typical project going on in Singapore on creating more attention for the intellectual property, for IP issues. Customer lifetime, we already talked about intangible asset called customer relationship, how to deal with that. We see an increased role of data in the overall economy. In particular, when you look at subscription-based type of business models like SaaS and what have you, so their data and data of your customers are getting more and more important. So these are just some other elements where we foresee that macro developments may impact the valuation standards for business valuation and intangible assets. Having said that, I would like to bring it to the next class and give it back to Alex.
Thank you, Henk, and thank you for that very good summary of the business valuation standards. So looking at the tangible asset standards, first of all, we have three main chapters there. We have IVS 300, plant, equipment and infrastructure, IVS 400, real property interests, and IVS 410, development property. Now, one of the things we do as a standard setter is we only have an additional standard or section if there is something unique in relation to that. So if something you feel is not covered within the tangible asset standards, you can refer directly to the general standards which cover all assets and liabilities. Next slide, please. So some of the changes that we've made is we've made consequential amendments in line with the revisions to the general standards. So you'll notice our chapters follow the same order in terms of the headings as the general standards. We've done revisions in relation to data and inputs, valuation models, ESG, and documentation. And IVS 300 always implicitly included infrastructure, but now it explicitly includes infrastructure within the standards. And some of you may wonder where the previous investigation section is in IVS standards, which was in IVS 102 before, and it's now all contained within the actual standards. And I'll talk about that a bit on the next slide. So if we have a look at the tangible assets revisions, it states within 40.06, sufficient investigations and evidence must be assembled by means such as inspection, inquiry, research, computation or analysis to ensure that the valuation is properly supported. And when determining the extent of investigations and evidence necessary, professional judgment is required to ensure it is fit for the purpose of the valuation. Now, I'd like to pause on this slide for a minute because both Paco and myself are part of a working group that will be issuing a perspective paper on inspections within the next few weeks. We've noticed that different markets have different requirements in relation to inspections. It can cause confusion between the client and the valuer because inspection means a different thing to both of them. So what we're doing in the perspective paper is we will have a classification of the different types of inspection, from a detailed inspection to a drive-by inspection, and that will allow valuers to be more transparent in their terms of engagement or in their scope of work. It will also provide you clarity if you're working in different markets in respect of some of the requirements that are in those markets in relation to inspections. So, for example, we know that in Australia, under API, a physical inspection is now mandatory for tangible assets, and happy to answer questions on that later with Paco as well. But please look out for the perspective paper. Next slide, please. So one of the things we did was we've incorporated new sections on data and inputs within the tangible asset standards to give an extra degree of detail. So we not only say that in accordance with IVS 104 data and inputs, the valuer must maximize the use of relevant and observable data to the degree that is possible, but we also state that in addition to these requirements, there is the following hierarchy of comparable evidence which would be followed for real property interest valuations. And these go from direct comparable evidence to indirect comparable evidence to general market data and other sources. And when applying this hierarchy, the valuer must ensure that the characteristics of suitable data and inputs contained within IVS 104 are fully applied, and also the selection, source and use of data of the inputs must be explained, justified and documented, and also significant ESG factors associated with the value of an asset should also be considered as part of the data and input selection process. Next slide, please. So in this slide, we're looking at valuation models, and in accordance with IVS 105, the valuer must maximize as many of the characteristics of suitable valuation models as possible. And valuation models must be suitable for the intended use of the valuation and consistent with suitable inputs. And the reason we say this is sometimes within firms, some people take a house model and use it for a purpose that it's not intended. So you do need to check that that model, whether it be in Excel or anything else, is fit for the purpose of the valuation that you're doing. Next slide, please. So like the Business Valuation Board, ESG is a key issue for us, but it's still in developmental stage. Both us and the Business Valuation Board have released a series of perspective papers. There's one on ESG and business valuation. There's one on ESG and tangible assets evaluation. And as mentioned, we will be releasing a perspective paper this year in relation to ESG plant equipment and infrastructure. And we've included more explicit ESG considerations in the tangible asset standards. In the scope of work, there is responsibility for the identification of actual or potential environmental factors, and that the property is free from contamination or other environmental risks. And under data, we state that significant ESG factors associated with the value of an asset should be considered as part of the data and input selection process. Next slide, please. So I've already spoken to you a bit about documentation and reporting. And in addition to the requirements contained within IVS 106 on documentation and reporting, a valuation report must be issued for evaluation and must include appropriate references to all matters addressed in the agreed scope of work. The report must also include comment on the effect of the reported value of any associated tangible or intangible assets excluded from the actual or assumed transaction scenario. And tangible asset valuers we won't value intangible assets. So that would be very much done by Henk and done by other business valuers. But if you're aware that they're there, you should mention them in a report. And moreover, in addition to the requirements contained within IVS 106, a valuation review report must be issued for a valuation review, and the valuation review report must state whether the review is a valuation process review, i.e. a review for compliance with IVS, or a value review, i.e. where you're reviewing one or more components of the valuation, but you are not issuing a new opinion of value. Next slide, please. So one of the big things that we're dealing with, and we were dealing with it when we were all meeting last week at the Standards Review Board, is our agenda consultation that should be coming out towards the end of June, beginning of July. And from the draft feedback that we got, the Tangible Assets Board felt that there were certain topics that they should look at: agricultural and plantation land, biological assets, compulsory purchase, expropriation, compensation, and unregistered land, insurance valuations, the difference between listed and unlisted assets, prudential value, which is a very big issue that will be coming in as part of the implementation of Basel III, quality control and the individual valuer, a little bit more guidance on how an individual valuer can do quality control, inspections and investigations. As mentioned, we've got a perspective paper coming out in the next few weeks. Valuation risk, valuation in a volatile market, and reasonable range. So though we issue values at a point in time, all our basis of value tend to be at a point in time, we do recognize that there is a reasonable range within this that is often decided by the court, and valuation reviews, appeals, and external audit. So that's a quick summary of the tangible asset standards. We'll now move to give you a summary of the revisions to the financial instrument standards. So next slide, please.
Alex, before you launch into that, just a quick one. On financial instruments, that's not formally part of TAKIM's mandate currently, but towards future-proofing, if we could give a high-level overview, that'll be useful for our audience. Yeah.
I think that's brilliant. And I won't be talking too much about financial instruments, but I do notice that we do have some crossover here as well, because many of you will deal with REITs. You might deal with the initial IPO, which then moves to a business valuation and then moves to a financial instruments valuation potentially. So we try and make sure that it coordinates across everything. So the new standard on IVS is across broad types of valuations, developed and developing markets, all sizes of firms throughout the world, one-time and ongoing valuations, and there's additional requirements in data and inputs, valuation models, and governance. Next slide, please. So when dealing with this, they were looking at consistency and comparability of the financial instrument standards, and they've got processes and controls around selection and usage of data inputs, model selection and usage, assessment of valuation risk, and execution of the valuation. And some of these more detailed standards may find their way into the general standards in the future, but standard setting is a process, and we felt that some of these requirements would be too prohibitive for our valuers at this point of time in the general standards, but obviously it's something that we'd be moving to. And it also goes through the processes that a valuer must do when using a specialist or service organization, both of which are defined terms. We use building surveyors, we use many specialists and service organizations as part of our work. And we need to make sure that these specialists and service organizations also comply with IVS to produce an IVS compliant valuation. But as a valuer, we have the ultimate responsibility. Next slide, please. So this chapter also looks at reliability. It defines and sets minimum competencies and processes required in evaluation. It has quality control processes, in relation to valuation execution, roles and responsibilities, review and challenge and assessment of valuation risk, and greater requirements in relation to transparency, such as documentation. Next slide, please. So just quickly going through, in future, IVS 500 financial instruments will look to provide additional application guidance to address implementation issues. They'll probably do this as frequently asked questions. They'll also be looking at professionalism, ESG, valuation risk, AVMs and AI. And I'd like to talk a little bit about implementation considerations. So when you're thinking about these standards, you should really think about the relationship between the valuer, the client, and the user. You should think about how you're using internal and external valuation specialists and service organizations within your instruction, and how you're memorializing their use. You should look at valuation process controls. In all valuation, there needs to be a degree of review and challenge, both in relation to the execution of the valuation, but also to the results that it gives. And you need to document the processes and the professional judgment. Next slide, please. So just, I think there's a slide before that, Taka, which deals with potential future topics, where we talk about clarifications related to valuation risk, additional requirements for valuation uncertainty and proportionality, expansion of requirements on sustainability and ESG, consideration of the impacts of new technology and valuation. In fact, the other day we were in a working group looking at that. We're seeing increasing use of AI, deep learning, machine learning, smart contracts, blockchain. What does this mean for a standard setter? We think there's issues that we need to deal with in relation to transparency. Should you state where you're using AI? And also just a word of warning to everyone that if you're using open source AI and you put on client confidential information, you've just accidentally broken your client confidentiality, because that information is now available to all the market. So please do think about that. We're also looking at expansion to new types of assets, such as digital assets, an example of which would be cyber currency. Do we need separate standards for this? Is there something separate in the way that they're being valued? And we have working groups considering this at the moment, and there may be additional standards in relation to that in the next edition of IVS. So we just moved now to our closing slide, but it's not really a closing slide. It's for Henk and myself, the main part of the presentation, and for Paco, an opportunity for you to ask questions and for us to try and answer them. And you'll notice the QR code. Please feel free to download it from your telephone. You will get further information on the standards, and you will also be able to access how you could get a hard copy of the standard, etc. So over to you, Paco, and thank you everyone for listening to myself and Henk. Shukran Katir, and we look forward to your questions.
Well, thank you very much, Alex. Thank you very much, Henk. And to the audience, thanks for your patience. I know we changed the format quite a bit. In the past, we would intersperse the questions, but we had to hold them to the end because Alex has other business commitments, including travel. So we have to do a hard stop a bit earlier than planned. So we'll address as many of your questions as possible. I will not be going to live mic questions, but I'll be cycling through the questions that you type into the Q&A segment. And so the first 7 questions were ready while we were doing the presentation. The next one is pretty much a procedural question. It says, how can I get the English slides? And that's a question from one of our members, that's Nathan Smith. And Nathan, I believe we answered that already. So the English slides were shared as part of a presentation we had in Q1, and they are readily available on Taqiyim's YouTube channel. Additionally, they can be shared with you as a slide deck. So just drop an email and we can do that for you. The next question, once again, a little bit of a procedural one for Taqiyim. in terms of attending a webinar 2 days ago, and that was the webinar on machinery and equipment valuations, with a focus on costing and pricing and the depreciation and obsolescence methods. With that one, it relates to getting your hours accredited to you. What happens is post-webinar, all attendees are compiled based on the attendance record. This flows through to membership, and membership ascribes hours. So you will get your hours provided you attended. The next one is an Arabic question. It has been translated just to make it more straightforward. This comes from an anonymous attendee, where it says, peace be upon you. I noticed that the new division of evaluation standards, that's the IVS 103 and 105, which is basically splitting up the valuation methods. That in the previous version, which was 2022, there were two separate standards for these in terms of the approaches, and then the reporting. 103 is actually reporting, so I'm not sure what this is about, but yeah.
I think what this question is in relation to the inclusion of appendices, Paco, and just to explain it, if we look at the current version of valuation approaches, which I believe is IVS 103, we do have a separate appendices on methodology. So there's several reasons for the inclusion of appendices. The first bit is, when we looked at it across the boards, we agreed that the general standards should be applicable to all asset classes, so business valuation, tangible assets, and financial instruments. And we noticed that some of the methods were actually more specific to certain specialisms than others. So some were more specific to business valuation or tangible assets valuation. So in order to deal with this, we created an appendices, which gives us greater flexibility to include methods. Another example of the appendices is the ESG appendices for data and inputs. You'll notice that the content hasn't particularly changed there, but what it does is it also helps deal with the confusion. You'll notice there's a definition for a valuation approach and a valuation method within the standard, because people get confused by the difference between approaches and methods. Just to be clear, and Henk also referred to this, there are three main approaches: the cost, income, and market approach. Underneath that, there are multiple methods. For example, a DCF is an income method under the income approach. So hopefully that gives clarity and answers their question, Paco.
Thank you, Alex. Next question also in Arabic from Zayed. In terms of attending workshops and getting your experience hours allocated to you, be it for machinery equipment or for vehicle damage and assessment. Once again, yes, you do get your experience hours allocated to you post-webinar based on an attendee list. This goes through to membership. It takes a while sometimes, but then it gets accredited directly to your member account. So that answers that. There's an interesting question. It says the session is an interesting one. Is it recorded? Simple answer, yes. Go to Taqiyim's YouTube channel and you get an answer to that. Majid, there's a question from you that's a slightly tricky one to answer, and I think it falls outside the confines of this webinar. So unfortunately, I'll not be able to answer that directly. Question from Shul. I'm working on evaluation, and I can see that the subject is already applied in the previous standards. Can you explain in a bit of detail what the practical difference between the current standards, which are effective January 2025, are, and the previous standards, which were the 2022 standards?
So that's partly the answer of this presentation, but just very quickly, we've got new requirements in relation to valuation process quality control, which is in IVS 100. We've clarified on competence and what compliance with IVS actually means. We've included additional definitions: professional judgment, professional skepticism, data inputs, etc. Please have a look through the glossary. The glossary is part of the standard. We've included new sections on data and inputs and the requirements in relation to the selection and use of data and inputs, new section on valuation models and the requirements in relation to the selection and use of valuation models, increased requirements in relation to documentation, and a new section on ESG. That's a very quick overview. We do have a red line version available if you actually want to see on a line-by-line basis the difference between the two standards. If you were compliant with IVS 2022, it's not going to change your valuation, but it's a greater level of detail and transparency that is required in the current edition of the standards. Remember, it's not effective till the 31st of January 2025, but we do encourage early adoption, because we would say, if this is valuation best practice, why not adopt it now? So hopefully, Paco, that answers that one.
Yes, it does, Alex.
I'd just like to point out, we do have a business valuation expert here. So if any of you want to get in the weeds on business valuation, Henk would be very happy to answer your questions. He's an extremely experienced global business valuer. So please do take advantage of that opportunity. But obviously, we'll both answer whatever questions you come with.
Thank you. In terms of, once again, procedural, in terms of experience hours, do you get experience hours for these sessions that you attended? Yes, they count as indirect, not direct valuation experience hours, but indirect hours for members. And they also contribute towards your CPE hours if you're an accredited member. Question on the standards, right? Do they address remote locations where it is difficult to sort comparable data?
Okay, so I'll start with that, and then Henk, jump in if you want to add more on that. Look, at the end of the day, all markets have data challenges. Not every market is transparent as other markets. Some data is better than no data, so you can only use the data that is available in your market, but you should try and follow as many of those characteristics as possible. We also have some challenges where the data is shown as incorrect and there is a duty of verification on the valuer. For example, I'm aware in some countries, the reported sale prices in the government directory relate to taxation. So not everyone puts the exactly correct amount there in order to try and reduce their taxation obligations, and therefore the valuer has to look at those and understand the market sentiment. But I think this is a big challenge in business valuation as well. So Henk, how would you say you'll deal with data challenges in emerging markets?
That's a good question, Alex, right? I mean, in general, I would say, and this does not only apply to, let's say, hard to get or more complex to interpret data, is always to understand the logic of the data, right? So when you come across data that, you know, don't sound or don't look that reasonable, or you can't explain them, remain critical in your interpretation before you're using it. I mean, we can't say too often that a valuation is not a mechanical calculation, right? A valuation does include the opinion of the professional valuer, as already indicated by Alex, right? So having said that, you still need to go through some of these exercises where the valuations are remote, or in, let's say, economies where you have harder to get data. We always say there, you know, try to link them as much as possible to similar assets, you know, in other markets. And secondly, you know, one key element to include when you look into these more emerging markets is also try to include a relevant country risk premium in your discount rate the moment you go to an income approach, right? I think that's for now, without going too much into detail, my reaction to that question.
Just thank you, Hank, and thank you, Alex. Just to add to that, right? Part of this ties to what Alex was outlining earlier on about the hierarchy of data and inputs. What I'll say is the test for the valuer is what would a competent valuer in your shoes have done to address the valuation problem to come up with a valuation solution. There are some asset classes or locations where data is hard to source. But based on that hierarchy of data and inputs and based on the work that was done, right? Will it stand muster if your peers were reviewing that? And would it be seen as the valuer has considered all the available data and inputs, competently analyzed them, and solved the valuation problem? So that's the mindset you need to get into, be it for intangible assets, tangible assets, or the subsets of other asset classes within that. The next question, two questions, but they are interconnected. From Ferris, can you clarify the valuation framework? And another question, which also touches on that, is basically the questioner wants to know if you can give a bit more detail about the valuation framework, and then 105, and then also 106. I know we covered all those sections in the earlier part of the presentation, but Alex, if we could track through that again and just give a little bit more elaboration.
Yeah, so when we talk about valuation framework, what we're really talking about is a structure that applies to all valuations. So in order to produce an IVS compliant valuation, and my apologies if I didn't explain it enough clearly previously, you need to comply with all the valuation general standards. So that's the valuation framework, which deals with competence, valuation process, quality control, and other matters. The scope of work, which you may also know as your terms of engagement, the basis of value, the valuation approaches, the data and inputs chapter, the valuation models chapter, and the documentation and reporting. In addition to that, you would need to comply with any applicable asset standards, because the asset standards give a greater level of detail to the general standards. So for example, if I was dealing with a development property, not only would I have to comply with IVS 100 to 106, but I would also have to deal with IVS 400, real property interest, IVS 410, development property, and IVS 300, plant equipment and infrastructure, is their infrastructure within that development. And only by complying with all of that will you produce an IVS compliant valuation. In terms of the chapters on data and inputs, IVS 104, and valuation models, we don't believe that we're asking anything that a good valuer would not be doing already. So most Accredited valuers should be doing this, and probably most of them are, but you can't just put in data. There's that saying, isn't there? Rubbish in, rubbish out. So you actually need to make sure that the data that you're using is suitable for your purposes of evaluation. And we give overarching criteria, both in relation to the data and in relation to the model, for the valuer to help make the determination that the data and the model that they're using is fit for purpose. So hopefully that helps clarify it, Paco. Next question, please.
Great, thanks, Alex. Next question is on agricultural lands. Is there a mechanism to work on these? I'm assuming that's the mechanism for value in these.
In terms of agricultural land, so that's quite difficult in a way. So it depends on how you're looking at the agricultural land, because you've also got to take into the principle highest and best use. Yeah. So if you're valuing it as agriculture, we don't believe there's anything different from the requirements that we currently have in IVS. But if it is physically, financial, or legally possible to turn that cherry tree orchard into a residential development, then you may also have to consider under market value that land being converted to an alternative use. Now, we will be exploring it as a board, and that's why it was one of the future topics we had there, was biological assets and agricultural land, to see if there's anything more that we can say on that. We know that there are accounting challenges, because if you deal with a palm tree, you actually have to separate the fruit from the tree from the product. But you would just follow the IVS 400 real property interest, which also deals with land and unregistered land. But we will be exploring whether any future standards are needed. And separately from this presentation, if you do happen to send an email to Paco or myself stating why you think we need further standards in relation to agricultural land, it will go straight to the Tangible Assets Board, who will consider it. So it's not an area where we think we need extra standards at the moment, but we will be doing prospective papers on this topic in future.
Thank you, Alex. That's a really good answer in terms of the purpose of the evaluation and what needs to be considered in and around highest and best use if it requires that, or if you evaluate assets in terms of its current use. Next question, that's specific to one of our evaluation sectors. That's gems and precious stones. If we will be conducting additional workshops and exhibitions, etc., in and around that. The answer to that is yes. It's the newest of the Taqeem faculties or sectors for evaluation. And as the courses are being rolled out, there will also be attendance CPEs, so that it buttresses the professional knowledge and experience and education in that sector. Yeah, thank you. The rest of the questions are taking a bit of time because they require translation first of all, and then we can address them.
Don't worry, while we wait for the questions to be translated, you know, are there any bits that you want Henk or myself to clarify to your members in respect of the questions that we've received so far? And maybe what we'll do in future sessions is, if people send in the questions earlier, it might help us with the translation. But Paco, go ahead.
Yeah, sure. No, finish what you're saying, and I'll move on to the next question.
No, I was just saying, if there were any bit where you wanted us to provide clarity to your members, you know, feel free to ask Henk and myself, and we will give whatever additional clarity we can.
Thank you. This question is in relation to the translated versions of the standards. So I know when we did the presentation in Q1, the translation was just about beginning. Currently, on the Taqeem agenda, we've gone through the internal review of the translated version. It's going through final cross-checks and quality checks. And the target is to have it ready and published ahead of adoption by Q3 2024. So it gives members enough time to understand and adopt it. In tandem with that, bearing in mind that the majority of our audience are primarily Arabic speakers, what we're doing is there's a wider program. So for these CP series that we're having on the IVS standards, the first ones was done purely in English. The second one is in Arabic, with Arabic slides, and we plan on having them on a quarterly basis, so that there's clarity and better understanding of the standards ahead of the adoption date. In sequence with that, we're also looking at all our learning and development materials, be it the core curriculum and pathways for qualification, and also our technical guidance manuals. All these are being updated as we speak to align with the updated versions of the IVS, which will be effective for adoption from the 31st of January 2025. Yes, so that's what's happening for US members in the background. So we're working hard to ensure that everything is aligned with the new standards ahead of adoption date. If there are additional questions, please send them through, because it looks like we're running out of questions currently. A bit different from the previous sessions, because we had 3-hour sessions and we had lots of questions. So I guess from my viewpoint, maybe that means that our members are increasingly aware of the standards, understand them much better now that we're about halfway through the publication process. So I believe that's a good thing. Question about land, once again, environmentally polluted lands. Can this be valued?
Well, everything can be valued at the end of the day. The problem with environmentally polluted land, or what we would call contaminated land, is the cost of cleaning up that land. I remember one time I was doing a valuation and it looked quite a good figure until I took into the account the contamination costs that take it to negative. But one thing to notice is we're not always the experts in this. So I might be doing the valuation of the land and I might notice there's a possibility of contamination because there's been a paint factory or oil refinery or something on the land. And then I would recommend in my valuation report that an external specialist is brought in to do a proper view of the contamination. I would also state in my valuation that this may affect the valuation figure provided. So a simple answer to your question is everything can be valued. You may need to bring in external specialists and be aware contamination can take it from positive to negative. I mean, I know, Pakao, you probably had experience on this yourself as well that you may want to add to.
Yeah, so as Alex rightly pointed out, depending on the cost to make good that land, you could actually be trending into negative values, right? So depending on the source of pollution or contamination, it may well be that the cost incurred to bring that land to proper use may outweigh the value of the land once that work is done. So depending on the purpose of your evaluation, etc., you need to consider these. Alex also touched on a really important point, which is highlighted in the data standards, the use of specialists. IVS makes allowance for the use of specialist inputs into your evaluation reports. It could be a land specialist, someone who specializes in cleanup of contaminated land. In and around demolition and debris removal, which may be one of the inherent costs within, say, insurance replacement cost assessments. If it was, say, a site used for chemical production, right, or it has significant oil spills, etc., you will need to look at the cost of cleanup, right, which will then be inherent in your value. Ultimately, the competency requirements and the sign-off requires that the valuer understands the inputs that are going into the evaluation towards evaluation conclusion. But there's no bar to bring in sector specialists or subject matter experts to help you quantify that cost. In a cost approach, for instance, real estate, if it's a really complex structure, you may need a quantity surveyor or building surveyor's inputs to do that. Once you get that costing data from them, that is, if you as the valuer do not possess the inherent costing skills or specialist costing capabilities, you can then use that as an input as part of your investigations, as an input into your valuation analysis to generate your valuation conclusion or valuation result. So yes, yes, everything can be valued, like Alex rightly summed up. It's just a question of what the value conclusion is based on the purpose of evaluation once that work is done. Hank, are there any areas you want to address for business valuations? I was hoping we'll get a lot more business valuation questions, given as you're here live to answer them, but we are not getting as many questions specific to business valuations as I thought we would get.
I'm ready to answer any question, Parker, of course, right? But maybe to sketch some light for those people not 100% familiar with valuation standards 210 on the intangible assets, right? I mean, as already indicated, when it comes to business valuations, we have the split into cost approaches, market approach, and income approach. We have a similar set of approach for the intangible assets, right? So when you look, for example, to certain assets that are intangibles that are also relatively straightforward to copy, we use cost approaches to value some of them, right? Take, for example, the workforce. The workforce is not a separately identified intangible, but a so-called contributory asset. For workforce, we very often refer back to the replacement cost approach. We do, however, have more and more questions about whether that's the right approach if it turns out to be a key asset. An asset for which we quite often use market approaches is the so-called, relief from royalty approach, right? When it comes to brand names, we try to find out whether that brand has been licensed out. Normally, when it's licensed out, you see approaches like, pay me a certain amount of revenues, let's say 2 or 3% of revenues, because you can borrow my trade name, when you sell your product. And then we use that royalty rate in order to value the brand. And then the third approach, which is much more of an income approach variant, is a so-called excess earnings approach, where we try to see how much of the earnings, which part of the earnings can be allocated to relevant intangible, and therefore, value the intangible through an excess earnings approach, right? So 3 different approaches for the intangible assets as a kind of, step into standards, 210. Thank you.
Thank you. Thank you very much, Henk. Alex, I have a question which may startle you, but it says basically that they hope that the presentation will explain the differences between the old and the new standards, so that the audience will be clear on what has changed. I believe that was the purpose of this presentation, but and I know that within the standards, the front end of each of the standards clearly identifies what the changes are, right, between the old and the new. But if you could elaborate on that a bit for our listeners. And I think part of this question is coming from the fact that the official Arabic translation is not ready yet, all right? So it needs to be ready for the wider audience to go through it and better understand the standards. Yeah, but for English listeners who have been through the standards already, that may be clear. So if you could basically point out a few more differences.
Yeah, so we've restructured the standards so the approach follows the approach that a valuer actually does. And what I mean by that is in the previous chapter, IVS 103 was reporting, which seems strange because reporting is the last thing that a valuer does in terms of evaluation. So first of all, we looked at our processes. Then we tried to clean up the general standards to make sure that they were general standards and equally applied to tangible assets, business valuation, intangible assets valuation, and financial instruments. And as part of this, we moved some items to the appendices. So you will notice that in IVS 102, basis of value, there is the same information as there was in IVS 2022, but it's appendices. So when we talk about the commentary between market value, market rent, investment value, synergistic value, liquidation value under for sale or reasonable marketing period, you will find the information there. So the information has not gone. It's still in the standard, it's been moved. We've done the same with the methodology where we've created an appendices, and we feel that this will give us the option to bring more appendices out in future. But I suppose one of the things that I'd really highlight is valuation process quality control and review and challenge. We have a statement that the valuer needs to stand back and look. Well, what does that really mean? It means that they should review and challenge their valuation, either internally through their firm or as an individual valuer to ensure that it's fit for purpose. And the other 3 main bits that I'll point out again, and I'm happy to keep pointing them out because they're that important, is the new sections on data and inputs, the new standard on valuation models, and the new requirements in relation to documentation. And if we bundle all the way through that, ESG and ESG considerations, I'd say those are the main differences, but it doesn't mean that the values will change. What we're doing is to ask the valuer to adopt a more transparent process in terms of their valuation. We're often very good at doing them. We're not very good at writing in the report what we have done and those professional judgments that we've made. So I'm happy to answer this question several more times, or we could record me and play it on a loop. But hopefully that helps. But, you know, it could also be, joking apart, it could be a translation difficulty. So if you don't feel we've answered that correctly, please do send a separate email to myself, Paco, and Henk, and we will find a way to answer that question as detailed as we can. But hopefully that deals with the differences. Back to you, Paco.
Thank you, Alex. To buttress Alex's point about being on a loop, right? Interestingly, all these sessions are recorded and they are placed on the Taqeem YouTube channel. But what I would say is, for your continuous learning, rather than just focusing on the presentation itself live, you can always go back and replay it, right? Because that gives you the option to track back, track forward, repeat stuff, and it should make the understanding clearer. So don't just view it as a CPE session where you get allocated hours for the 2 or 3 hours of attendance. For your continuous learning, and so you're familiar with the standards ahead of the adoption date, please play this one back. There was one in Q1. The questions were different. The focus was different. Then this one in Q2. Once again, we have a whole raft of questions. So what I would say is, please replay those. It's free for members. You can go back and play them, and it should make things clearer. There's a question on the new standards, if there's a free version available on the Taqeem website. The answer is no. Like I explained like I explained earlier on, that is going through final translation checks. And when it is ready and officially issued in Arabic, you should be able to get access to it at that stage. But currently, there's no official Arabic version of the standards. The English version has been available for quite a while now. The publication date was the 31st of January 2024. So that is accessible through the IVSC's website directly. A bit of a tricky or controversial question. In and around valuations during times of war, do valuations stop or do valuations continue?
Markets continue, valuations continue, but obviously there's a number of factors to consider. I mean, for example, we were recently looking at, I'm going to give an example here. I'm going to go to Ukraine. It's a very unfortunate situation there. But if you've got a building that has been damage, that was built, let's say, by the Soviets in the 1960s, you wouldn't necessarily build that same building today. And so that makes it quite difficult. So as an organization, we're not political, we just deal with valuation, but we have reached out to organizations to say, we can help you with standards in relation to valuation. I believe the existing standards on that go back to the UN. I mean, we have a Ukrainian in the Tangible Assets Board, don't we, Paco?
Ludmilla love this question here.
Yeah, who often brings this up. And I think Ludmilla actually did an article, if I'm right, in the RICS journal, which if you have a particular interest in that, you would find out more. I think the difficulty is, are you building a model equivalent? Are you replacing exactly what is there? There's questions in relation to insurance and other matters. It also becomes very political because when you look at the compensation, who is actually going to pay the compensation? Have they agreed to pay the compensation? But obviously, this is a different, difficult area. The political bits lie outside of IVS, but in terms of valuation practices, that's something that we can assist in the process. I don't think there's much more we can say at that time. I mean, it's probably even harder just switching it over to Henk, because it's a tough question, that when you deal with a business that has been affected by a war, I would think that's even harder when you're looking at compensation, particularly if they're in more than one market. I don't know if you've got any thoughts, Henk, when you look at that.
Thanks, Alex. It's indeed a very difficult question. Huh? But as you say, also business will need to keep on going in case of war. And then the key thing to consider is, what's going to be the ultimate impact, right? And considering the luckily, one-off events of these major disturbances, that is very hard to do, right? So my recommendation when it comes to business valuation is that you fall back to what we call scenario analysis, right? So there is a tendency sometimes, or as a first reaction, to include the increased level of uncertainty in your discount rate, but that takes all types of difficulties how to do so, right? We would rather suggest in a situation like this to come up with a couple of scenarios. When will the war be over? What will the impact of the war? Try to assume what that will do for the relevant value drivers, come up with a couple of scenarios and build your valuation upwards using these scenarios. That would be my general recommendation. I do consider it's a quite difficult exercise to do, but that is what valuation experts stand for, right?
Thank you, Henk, and thank you, Alex. And Alex, is actually quite uncanny that this question comes up, given the discussion we were having yesterday around these aspects of reinstatement or replacement, focused on insurance and all that. So that's interesting. Henk, I have one for you. In terms of the approaches and methods used in valuations, are there optimal approaches and methods to use in the valuation of impairment of goodwill on an annual basis?
Good question, right? I mean, when it comes to goodwill impairment testing, I think that it depends, of course, a bit on what accounting standards need to be used. But in general, it is relevant for a goodwill impairment test to determine the so-called fair value of the relevant unit of the relevant business, right? I mean, under US GAAP, it really boils down to determining the fair value of the relevant reporting unit in which the goodwill resides. When you talk about IFRS, we talk about the relevant cash generating unit for which you have to determine the fair value, right? On the IFRS, fair value is even, detailed out a bit more, right? Under IFRS, the leading valuation principle is recoverable amount. Recoverable amount boils down to the maximum of the value in use versus the fair value less cost of disposal. The fair value less cost of disposal is a relatively straightforward one that again boils down to determining fair value. The one that requires a bit more attention is value in use. Value in use, at least in the existing version still of IAS 36, is more focused on how the asset is being run by current management. So value in use, therefore, is very much dependent on what's management current intention with the relevant asset, and there base your value upon. If you see to some interpretation documents and to the goodwill impairment slash study that the ISB is doing now, they are trying to make value in use a little bit less restrictive, right? In the existing days, still, value in use, for example, is restricted because you have to do all types of different assumptions, like you have to discount the pre-tax cash flows with the pre-tax WACC. You cannot, do too much restructuring on your assets. And there's, currently, as we speak, a discussion document out there of the IASB, evaluating IAS 36 and evaluating IFRS 3. And they are really talking about, relaxing those, exceptional elements of the value in use. So ultimately, it will also boil down more and more to determining the fair value.
Thanks a lot, Henk. And thanks for the focus on the international financial reporting standards, because that's what guides financial reporting valuations for Saudi Arabia. So it's pretty much the same as IFRS, but IFRS has adapted for Saudi. So that was a really helpful question. I'm sorry, answer to the question. There's a question on adoption, and this is one for Taqeem. Regarding the standards given as they were published in 2024, and the effective adoption date is in January 2025, are valuers allowed to continue issuing their reports under the as yet effective IVS standards? The simple answer is yes. So if you've been working with the IVS published in 2022, and there's an IVS which has been published in 2024, but for effective adoption, it's not until January 2025. You are allowed during that transition period leading up to mandatory adoption to continue using the earlier version of the standards. That is practical. And also from a Taqeem standpoint, like I explained at the start of this, the official translation of the Arabic IVS is not ready yet. So we cannot require you to adopt it mandatorily before the IVS's own prescribed adoption date. So yes, you can continue to work with the older version of the standards. This webinar series, in addition to everything else we're doing, is geared towards getting our membership and our followers ready ahead of the cutoff date of 31st January 2025 for mandatory and effective adoption. So yes, you can continue to use the old standards until the new standards are ready. IVSC, let me check this in before Alex reminds me, encourages early adoption. So if you're familiar with the English standards, if you're comfortable using those, you can begin to use those in your reporting. Alex made a point earlier on that in terms of the principles of valuation, they have not changed. The IVS is a principles-based standard, right? So in terms of the methodologies and how you will basically carry out evaluation, it's not going to be materially different. What the updated standards do is they buttress areas where we believe valuers needed more guidance, right? And the language has been strengthened in terms of the musts and the shoulds, etc. So it's much clearer to see what is mandatory and what is guidance within the principle-based standards. Yeah. Alex, do you want to add anything to that?
No, I think you did a very good summary there, to be honest, Paco. And just remember that both myself, Henk, and obviously the members of the boards, which include Paco, we are available to answer questions. So if you have a moment, which I often do, the presentation finishes, the questions finish, and I think, oh, I wish I asked that. You still have the opportunity to do that, and we'll try and answer them.
Thank you very much, Alex and Henk. There are a couple of questions coming through now. Give me a few moments to sort those ones out, we can address them. All right, so this is a question for, I'll let Hank take a go at it first. Banks and financial institutions generally issue their own internal evaluation reports. Are they required to adhere to the standards as in internal valuers versus external valuers? Are they required to adhere to IVS standards?
Well, I mean, we of course would recommend them to do so, but in case they don't really have good formal policy in place that they have to follow IVS, there is no legal need to do so, right? So only in case, you know, banks have become a member of IVS, then there is, right? But it's a voluntary decision, right? I mean, that's what I can say. Maybe Alex, you would like to elaborate a bit more on it.
Yeah, I'll just add a little bit more. Look, for secured lending and for mortgages, it's quite common that banks will have their own pro formas, and you need to bring in the pro forma as part of the instruction. But I'm going to use the term get out of jail free wrongly, but it doesn't mean that you can ignore the standards. It means that that information still needs to be contained on your file and within your documentation. But we are aware that in some cases, particularly secured lending, there will be particular pro formas that are used. So you should fill in the pro forma because that's what you've agreed with the bank in your scope of work. But then according to IVS, you also need to include that additional information within your documentation. So for example, if the pro forma only gave you one line for the valuation approach and you just put cost, income or market, that might deal with your pro forma. It wouldn't deal with your requirements under IVS, where you've got to explain your professional judgments in terms of the approach that you adopted and those judgments made behind that approach. So I hope that clarifies it, Paco. Does that make sense?
It makes perfect sense. Yeah. Thank you, Alex, and thank you, Hank. A question on land valuations once again. So the scenario is you're valuing land, there is construction in progress or assets under construction on the land. What is the recommendation when you're valuing this?
Well, obviously, I would go straight to IVS 410 development property, because it's now moved from being land to being a development property. Probably the main method of valuation you would use is a residual valuation, where you're looking at the gross development value and you're going all the way down to the actual value of the land. However, there's a few things that I'd point out. We do state in the standards that where you've got uncertainty, we would recommend that more than one valuation approach is used. I would say that this is definitely an area, development land, where there is uncertainty. So you should think about using more than one approach. We also talk about the as proposed and as is for development. There have been mistakes made in the past where the valuer is giving a valuation based on gross development value, and the person who is making the loan doesn't realize that that is not the value of the asset at the moment. So it's very clear within the standard that you need to provide both an as proposed and as is value. But the main thing that you'd look at is IVS 410 until you get to the development being completed, in which case you might be looking at IVS 400, but you also might be using a special assumption. If it was a hotel, you might be saying market value under the special assumption that the development has been completed and normal trading potential has been established. So there are complications within that, but IVS 410 should walk you through that. I don't know if you want to add any more, Paco, or...
Yeah, that's actually a perfect answer. I just want to give a bit of an elaboration in relation to an aspect of valuations. So when you're doing, say, fair value work, be it 3D or be post-due purchase price allocation, what I would say is, since a lot of it is related to the assets on the book or the fixed asset accounting register, depending on the agreement you come to with your client or with auditors, sometimes you can do a valuation of the underlying land. And in terms of the assets under construction or the construction in progress, you can hold those at cost, because you will have clarity on what the cost to construct is up to that point in time. So you can report it that way. This relates specifically to purchase price allocation, because you're going to segregate the values between the land, the buildings, and the different asset classes, be they tangible or intangible assets. So that gives you some leeway. But yeah, in simple terms, depending on the purpose of your valuation and the client requirements, you can look at land on its own, or you can look at the land together with the improvements on the land. Yeah, it all goes back to the purpose of the valuation and what the end users or the intended use and the intended use of the valuation is. Yeah. Give me a second to find one more question. It looks like, yeah, we have basically addressed all the questions that were sent through to us. like Alex said earlier on, if you do have any follow-on questions, kindly email them to Taqeem through the communication platform. And what we'll do is we'll look to get back to you with answers to all your questions. What I also did say at the beginning was we would have to likely have a hard stop at 3 p.m. because one of our panelists, Alex, has other work engagements which involves travel. So I don't want Alex to miss his flight today. So if there are any questions coming through, we have 5 minutes to go. I will address those ones. Okay, actually, there's one that just came through. And we'll answer that. That will be the last question, and then we'll wind down. Alex, Hank, this is a question on ESG. There are debates on the benefits of including ESG in evaluations. Final thoughts? Are there any benefits to including an ESG analysis, or is it more so a requirement than a look at the benefits or disbenefits?
Well, I mean, apart from the obvious, the benefits to the society, world, planet, and population as a whole, the point I'd make is there are requirements in different markets in relation to ESG. So it is not a choice. If you are working in Europe, you have to follow the EU taxonomy. If you are working in an aspect of financial reporting, you will have to follow the International Sustainability Standards Board. I mean, I don't think it's something that we can say. It's something where I'll get it right this time. The ship has actually left the port. We need to consider ESG within our valuations. And I'll just point you to one of your neighboring countries, Dubai, where we were suddenly faced with floods like we'd never been seen. So there is a graphic example of how ESG can affect the assets and can affect the valuation. So I would sort of turn that around and say it is not a question of choice. It's something that we have to consider, but we have challenges in relation to data, particularly on the social and the governance side, and we're still in a data gathering exercise. Henk, over to you, just in case you want to add a bit more to that.
Definitely, Alex, thanks. I don't think there's not even only a regulatory requirement to include them, right? But what you clearly see is that the topic has become a much more important value driver over the last decades, right? I mean, it's an interest that shareholders have, it's an interest that regulators have, and as a result, it's an interest that also the corporations have, right? So I think you must include, any ESG factors in your valuation to truly come up with a high quality valuation, right? The key question, of course, is how to translate the ESG features into cash flow terms, right? I already touched upon that point to a certain extent, but that is the key question, right? I mean, as important as they are, they simply need to grow to the approach of, what's the impact of an environmental, social, or governance factor on your overall free cash flow to be estimated for the upcoming years, right? But, for me, it's not a question of whether to include it, but how to include them in the right way. And I would say include them in a way that you try to quantify the impact of these factors on your expected cash flows.
Thank you, Hank. Just to add to that, right, from a Saudi perspective, looking at tangible assets, real estate specifically, there's already data which enables you to incorporate that into your valuations. So looking at the three main approaches, you're looking at, say, the market approach, the building rating systems for commercial property and for residential property. That's Mustadam. As more buildings get rated, that basically gives you an input into your valuation. The greener the building is, the likelihood of getting a green premium on that, or a brown discounts, the more pollutant the building is. In terms of the income approach, like Hank rightly pointed out, in terms of building up your discount rates, etc., as you begin to look at the risks associated with changing certain building services because they no longer comply with environmental governance type legislation, it will have an impact on your valuation. In the cost approach, once again, when you're considering depreciation and obsolescence factors, right there, you can look at external obsolescence, which is basically stuff that is outside of your control. If you need to change heating, ventilation, air conditioning systems, because government regulations do not allow it anymore in terms of its use for the valuation, that would have a cost impact, be it positive or be it negative. The greener or the cleaner the building is. So it is already here. And Saudi, as you all know already, has a huge agenda in and around what we call the circular carbon economy, right? There's a Saudi Green Initiative, there's a wider Middle Eastern Green Initiative. And you look at a lot of the giga projects and the mega projects, they have components in there of sustainability, heritage, environmental, social, and governance. You look at Vision 2030, these are all embedded in there. So I believe it's already here. And it's a good thing to start considering them if you're not already doing so in your evaluations. Any other comments before I wind down? I know we're literally 1 minute to go, so you good? All right, cool. I'll let you go catch your flight. Thank you very much. Audience, thank you. We did our best to answer as many of your questions as possible. Actually, we answered all of them. And we're going to stop the webinar now. Any further questions, kindly send them through and we'll do our best to address them between Hank, Alex, and myself. Assalamu alaikum. Thank you all.
Masalama.
Thank you. Bye-bye.
Bye.